Good afternoon. My name is Kim Pennico, and I'm Director of Economic Justice Programming at the National Network to End Domestic Violence. And I want to thank you all for joining us today, and welcome to a session titled What Survivors and Advocates Need to Know About Filing Taxes. We are pleased to have you join us today, so thanks so much. I know many of you have incredibly busy lives and work very hard at what you do. So thanks so much for taking the time out to either join us live today, or if you're listening to this after the fact, thanks so much. It's my pleasure to introduce you to our two speakers today. Pardon me, Andrew Van Siegel is the Director of Low Income Tax Clinic at Prairie State Legal Services, and Roxy Caines is Earned Income Credit Campaign Director from the Center on Budget and Policy Priorities. So as you know, this session we're going to be talking about the fact that the U.S. tax code is structured to provide assistance and deductions to low-income taxpayers. This webinar will provide trusted resources and information to help you and your survivors learn what to look for, where to turn, as well as what to avoid when it comes to filing taxes. So, I got a message from Andrew that my voice is scrambled. Is this any better? Can you hear me? Oh, wonderful. I hear that's better. Thank you so much. So let me start over for just a second. So good afternoon. My name is Kim Pennico from the National Network to End Domestic Violence. I got two messages here. One says from Andrew it's jumbled, and the other is from Roxy, and it says it's better. I'm wondering if you are listening through your computer, if it's jumbled, so you may want to do the call-in. So mute your computer line and listen through the phone. It may help. Oh. Well, I'm hearing from one that it's better. So I will try calling from another line and see if that's, well, actually I think we've got to do it through this one. Well, what I'm going to go do is I'm going to hand the line over then to Andrew, our first speaker, and see if he has any better luck. Let me unmute Andrew here. All right.
Hello, everyone. Hello.
Yes,
okay, looks like we're off the ground and running. So sorry about.
And I think, Andrew, it might be your end. Your phone sounds a little garbled as well.
Hello. Can anyone hear me?
I can hear you. It's just a little. It's a little challenging.
Oh, well, that's going to be trouble. I am dialing in through our Ethernet connection, so I'm not sure where the. Or I'm dialing in through my phone connection, so I'm not sure where the issue may be.
Okay. Yeah, it sounds like maybe it's on that end because Roxy's experiencing the same thing with when you speak. So we have two choices. You can either try hanging up and dialing from another line of either your cell phone or however you want to do that. And I can start with Roxy, or how do you want to handle that? My apologies to the group. We didn't realize this ahead of time.
Right back in then.
Okay, no problem.
Let me call in.
My apologies. I'm going to go ahead and pause the recording for now. Hold on one second. Recording, so hold on for 1 second. All right, we've resumed recording, and I think we've got a better line here for Andrew. So, Andrew, the floor is yours. Can you see your PowerPoint?
Let's see. Yes, I can. Okay.
Wonderful.
And I can advance those slides myself, correct?
Yes, you should be able to.
Okay. Well, all right. We will go ahead and get started. My name is Andrew Van Siegel. I'm the Director of the Low Income Tax Clinic at Prairie State Legal Services. We are a low-income tax clinic that's funded in part by the IRS, and we cover all of northern and central Illinois. It's 36 county service area. We have a dedicated intake hotline. If anyone out there is in our service area and knows of a client, friend, family, or even yourself with a tax issue, feel free to give us a call. There are eligibility requirements for services, but it's a 100% free service. There's also clinics just like ours throughout the country, and if you pull up publication 4134, you can find a list of those clinics throughout the country, and I think there's just over 100 of those clinics throughout the country. Okay, so the objectives for my portion here is to just go over a handful of issues that are impacting victims of domestic violence. And some of them are kind of issues that are standard for anybody to consider, but we'll kind of talk about the domestic violence slant as we go through some of these as well. And before I do really get into much substance, I always like to go through a tax return and kind of explain how it works. Because a lot of times people on this call or your clients, they really only know two things. They want to know how much am I getting or how much am I going to owe and where do I need to sign, and in the age of e-filing where they sign their acknowledgement. Okay. So the way income tax return works is that your information, personal information like your name, address, social security number, they show up on the top portion where it says personal information there. And below that is where you're going to be able to select your filing status. Now the filing status is going to impact the calculation of how much tax that you're going to owe. So if you're filing single or head of household or married filing jointly, you're going to fall into a different tax structure. So that's kind of important to keep in mind. Filing status is an election that the taxpayer gets to take, so long as that they actually qualify for that filing status. So for example, somebody who's filing as head of household may still be considered married, and that might not be the appropriate filing status, and that return is going to get flagged for an audit. So that's just something to kind of keep in mind. Below the filing status, you'll have your exemptions and your dependents. So traditionally, people think of a dependent as somebody, like your son or daughter or a grandchild that's living with you. That's where their information would be listed on the tax return. Below that, we have all of our income items, so things like wages, unemployment, pension, Social Security. All of those items are going to show up all in that section. So it's important to understand what type of income you have, because sometimes less than reputable tax preparers will miscategorize the income on purpose, because some income is considered earned income for purposes of the earned income credit, and some of it is not. So wages would be considered earned income, but unemployment would not. So sometimes the return preparer will incorrectly report the income, and it's going to significantly increase their earned income credit. And then a lot of times they charge high fees for that, so they're taking a large part of that earned income credit in the form of their fee. Adjustments are policy-driven items that show up on the return that are going to reduce your amount of taxable income. You're going to net those two numbers together, your income, subtract your adjustments, and then it's going to give you your adjusted gross income. The adjusted gross income is then carried forward to the next page of the 1040, and then it just kind of comes into a long math problem here. So in my PowerPoint, there's kind of an interactive animation on it, but we'll skip over all of that. Again, your deductions are going to be based on how many exemptions and what your filing status is, and that's going to determine your taxable income. So just because you earn $20,000, $30,000, or $40,000, it doesn't necessarily mean that that's what you're actually paying tax on. It's after all of those deductions are in place before you can really determine how much taxable income you have. And then there's two types of credits that are going to apply. There's a non-refundable and then a refundable credit. And Roxy's going to talk about some of these on the second half of this portion. A non-refundable credit is a credit that's going to benefit you to the extent that you actually owe tax in the first place. So for example, if you owe $500 in taxes, the most you could have in the form of a non-refundable credit is $500. On the other hand, a refundable credit is a credit where even if you don't owe anything in federal taxes, or the refundable credit exceeds the amount of tax that you owe, you're going to get the difference in the form of a refund. So it's just kind of a brief overview of how this works. So it's important when you're dealing with taxpayers that they really understand where everything is supposed to show up and line up on the tax returns to really prevent problems before they even arise. So I put up a slide here which I always like to illustrate these, to highlight these misconceptions of when you have to file a tax return. A lot of people say, well, I didn't have to file, or I didn't make enough money, or just all these types of things that are just very inconsistent as I go out into the community and kind of pull them to ask when they actually have to file a tax return. This is a very basic slide because there's the problem with tax administration is that the rules are pretty straightforward, but then there's exceptions, and then there's exceptions to the exceptions, and that's what makes it rather difficult to understand. This chart here is based on a taxpayer in 2013 that isn't being claimed by another person as a dependent. So in other words, if you look down where it says head of household, and you probably might not understand what that means, but for most purposes that's going to be your single mom or your single dad, somebody who's unmarried and has a dependent child. In this situation, head of household, if you're under 65 years old and you earn less than $12,850, you don't have to file a tax return. There's no requirement. The IRS isn't going to come knock down your door asking you to file a tax return. It's just not required. Now this is for wages. So if you're self-employed, if you're cash-based business, then that threshold is much lower. I believe it's $400 if you're self-employed. Okay, so it's significantly different. So why would we want to file a return if we don't have to? One of the major reasons is the earned income credit. So in 2013, this is the distribution of what this credit is worth, and Roxy's slides are going to show the distribution amount for 2014, which is slightly higher. But this is a refundable credit. So this means if you don't owe anything in federal taxes, you're going to get this in the form of a refund. So let's look at our chart here. And this head of household person, so a single mom making maybe $10,000 of income, doesn't have to file a tax return. But when we look at this chart, if she has one child, she's going to get that maximum benefit. And in 2013, that was $3,250. And if she had three or more qualifying children, that benefit's going to just be right around $5,000. So that's a major reason why somebody who's not required to file a tax return would still want to do that, because they want to get that refund. So there's other credits in play here as well. There's an adoption credit. There's a premium tax credit. So Roxy's going to talk about the Affordable Care Act and the health care subsidy that's available. It might be a prerequisite for public benefits, or if you're applying for financial aid, you might have to file this tax return even though you're not required to. And I always tell people filing through the VITA program, where it's going to be 100% free, Roxy's going to talk about that as well. Filing that every year, whether you have a requirement or not, is really the best way to go, because you never know what's out there in terms of credits. It's not going to cost you anything. If you're going to get a refund, you'll get that refund, and it could possibly prevent identity theft, because you're essentially going on record every year saying that this is my name, this is my number, it's being filed, and nobody else is going to be able to do anything sinister regarding your information in terms of filing fraudulent tax returns. So I'm briefly going to cover filing status, and very briefly the tax credits in play, because Roxy's really going to focus on that. But again, filing status is going to largely tie into your tax structure, and in certain situations, especially for domestic violence survivors, it's going to be there's a discussion to be had as to what the correct filing status is. So with married filing a joint return, there's a common misconception that if you're married, you have to file a joint return. And if you're separated or in the process of getting divorced, that's when you'd file it separately. It's not true. Filing a joint return is completely an election that both taxpayers get to make. The benefit of filing a joint return is that they're going to get a preferential tax structure, meaning their rates are going to be a little bit lower. The phase-in and phase-out for credits and deductions are going to be more favorable. And they're going to be eligible for earned income credit, whereas if they're filing separately, they're not able to do so. So when we have these family law cases, that's kind of a tricky situation, because if you're filing separately, you're not going to get that earned income credit, which could be several $1,000s. But you might want to be filing separately because you're living outside the household, or you don't know what the financial workings are for this other person that you're separated from, or you've left them because there's violence in that relationship and you don't want to further communication between the two parties. So there are options available in those situations where somebody who leaves the household but is still married can still claim that earned income credit. And we'll get to that in a few minutes here.
So can I just ask a quick question, Andrew?
Sure.
Make sure I understand. So if you are if you aren't married, you are eligible for earned income tax credit. But if you're married, and file separate, you can't get it. Is that right?
Right. So yeah. So another way to look at it is that you're eligible for this credit for any filing status except for filing separately. It's going to make you ineligible. And
so
I think the reason
why separately, gotcha.
Right, and I think the reason why is because you can kind of manipulate the system. You know, theoretically, if we go back to this chart, we could have a couple with 2 children, and they both make $30,000. So they make $60,000 total. They would be ineligible for this credit. But if they filed separately and each claimed 1 child, they could kind of game the system and get that earned income credit when it's really not designed for that specific family unit, because their income is considerably higher than what they're really reporting on that tax return.
Got it. Thanks.
Okay, so married filing separately, I kind of alluded to some of the points here, but again, it's an election that's made by the taxpayer. They're going to be at a slight disadvantage because their tax structure is going to be a little bit higher than what it would be if they're filing jointly. It's going to make them ineligible for certain benefits like the earned income credit, student loan interest deduction. They're not going to be able to get that as well as a number of other deductions and benefits. Also, if they're receiving Social Security, it's generally not going to be taxed, but if you're filing separately, in some cases it could be considered taxable. Okay. The benefit, though, is that you are separating your income from the other person, which means if you get a refund, that's going to be 100% your refund. And if your spouse owes money, you're not going to be on the hook for that debt. Whereas if you file a joint return, you are personally responsible for anything that's on the return or anything that you've omitted. And that's very important because a lot of couples that are splitting either somewhat amicably, or if there's violence in the relationship and the survivor is fleeing that relationship, you know, they really don't know what's going on with the other spouse. They don't know what's going on with the financial affairs of the household, and they're kind of pressured to filing a joint return because they want to get that higher refund. But things could happen where they're not reporting all of the income, and you really have no basis to know if the income's being reported. And then you get audited down the road, and even if you've left that relationship, you're going to be personally liable for the tax that's due. And there's ways to get out of that, and that's what we'll talk about here in a few minutes. Another thing a lot of people don't know is that once you file married filing jointly, you can amend to file separately, but you have to do it before the filing deadline of that year. So, for example, this upcoming filing season, if you go out and file a tax return at the beginning, the first day to file in late January, you could still go back and amend that up to April 15th, but as of April 16th, you can't separate that liability. You can't file a separate return. And it's just the opposite. For married filing separately, you can amend, both taxpayers can amend their return to file as a joint return up to 3 years from when the return was due. So for example, the returns that are going to be due in April of this upcoming year are for 2014, The filing deadline is April 15th of 2015, which means they have 3 years on top of that date to amend from separately to jointly. Okay, so this is the filing status moving on to head of household that is the most confusing for a lot of people, because a lot of people think that when they're single, they should be head of household. A lot of times married people are filing as head of household. And there's a lot of misconceptions here, so we'll try to sort some of these out. The easiest way to think of head of household is your situations where you have a single mom or a single dad. So it generally has to be an unmarried person that's claiming some person as a dependent most of the time. Okay, it's going to give you a slightly higher standard deduction as if you're filing separately. So it's going to give you a preferential tax outcome. It's going to enable you to claim the earned income credit as opposed to if you're filing separately where you wouldn't get it. Okay, so that's always the question as to how can a married person file as head of household. And there's a special rule where if you're still married and you're living outside of the household for the last 6 months of the year, and you otherwise meet the requirements to file as head of household, then in that situation you would be able to file head of household. Okay? But a lot of people misapply that rule, and it's a huge red flag. If you're married, generally you're not going to be able to file as head of household unless you're able to just meet the basic eligibility. And if you're married, you have to live apart from your spouse for the last 6 months of the year. And these are generally picked up pretty easily through the IRS's algorithms, and they pick up these issues for audit pretty quickly. And usually what that means is that if you don't meet the test for head of household, then they're most likely going to make you file as separate or jointly. And if you're filing separately and received a large earned income credit, then you're going to be left owing that money back plus penalties and interest. So some items you want to consider for filing status. Again, we're assuming that we can trust our spouse, and in most situations hopefully that's the case, but you run into situations where the spouse might be secretive of the financial dealings, or just maybe not secretly but not as open and out in the air about it. And a lot of times when we see cases of physical violence, there's also attached to it financial abuse as well, where there's not any financial freedom within the household and everything's usually one-sided. So that's something that your client should consider when they're filing their returns in a couple of months, as to whether or not they should be filing married, filing jointly, married, filing separately, and in the situation where if they're married but living outside the house for the last 6 months of the year and have a dependent, that they could file head of household.
So, Andrew, there's a question here from Molly. What if you declare domestic violence? Then does it still have to be the 6 months?
Yes, so the domestic violence is not going to have any impact on those rules. It's a very strict rule. There's different, when you get into that premium tax credit, the eligibility is similar to earned income credit, meaning if you're filing separately, you're ineligible to get that health premium tax credit. But there is a provision that will allow victims of domestic violence, if they assert that, to still be able to file separately and get that credit. But in terms of head of household, no, there's no special rules for domestic violence. It's a very strict rule.
Thanks.
Okay, so in most of the times when I do my lectures about just tax basics, I usually start with dependency, because dependency is kind of a foundation for head of household. So if you're still not 100% on head of household, it might make a little bit more sense after we get done talking about dependency. So for dependency, there's two types of exemptions. There's a personal exemption and then a dependency exemption. Everybody on this call has their own personal exemption. If anybody on the call has a child or a grandchild or a parent that they claim as a dependent, that would be considered a dependency exemption. And each year, a dollar amount is tied to how many exemptions you claim. So the slide up here is for 2013. However, in 2014, that amount is $39.50. So it's a $50 increase from the year prior. So what this means is that if we have a situation where we have a family of 5, two married taxpayers and 3 children, in 2013 their exemptions would total $19,500. Now that means that that's going to reduce from the amount of income that the family earns. So if somebody's making $20,000, $19,500 is being wiped out right off the bat just from the exemption. This is before their standard deduction or any type of credits or payments or anything like that. So dependents for tax purposes are a good thing. They're going to reduce your taxable income, and it might open the door for certain benefits like earned income credit or child tax credit. And in order to claim somebody as a dependent, they have to be this term of art which is called a qualifying person. And a qualifying person can be either a qualifying child or a qualifying relative. And these tests are very strict, but it's an all or nothing test, and the way to analyze these situations is you're going to first try to see if they get in as a qualifying child, and if they're not able to, you go and run the analysis as a qualifying relative, and at the end of the day, they're still treated the same for tax purposes if they meet these tests. And the categories here, I don't really have the headings on them, but you can kind of guess what they are. The categories here are age, relationship, residency, support, and then kind of a miscellaneous column. So the purpose of this call isn't really to make you an expert on how to claim somebody as a dependent or filing taxes. It's just to kind of give you some background. But you'll see here the rules for qualifying child are pretty much going to be your garden variety taxpayer that's a married couple with children or a single mom or a single dad. So if you have a 5-year-old daughter, you're going to be able to easily get through these tests. They're under 19, it's your child, they live there at least half the year, they did not provide more than half their own support, and nobody else is claiming them as a dependent. The tests for qualifying relative are a little bit more expansive in terms of age and who you can claim, but it's a little bit more restrictive in terms of support and the income test. So you actually have to be providing at least half of this person's support, and their income has to be less than whatever the exemption amount is for that year. Okay, and I noticed there's a comment here on the chat feature. So when Roxy gets to talk about the premium, the health premium credit, this is a subsidy for your health care costs if you're buying insurance on the exchange. And in order to qualify for that, you have to meet all the other comprehensive tests, but when you file your tax return, you have to file either head of household, single, or married filing jointly. If you're filing separately, it makes you ineligible. However, there's a narrow exclusion for victims of domestic violence where they can kind of circumvent that exclusion if they're married filing separately. Okay, so going back to dependents, so that's just the general overview of whether you have a qualifying child or a qualifying relative. So you could still have a situation where, let's just say you have an older parent and they have a 30-year-old child who, for any number of reasons, is living at home and not working, and you're providing their support. You're going to be able to go through this test here for qualifying relative and see that you can still claim them as a dependent, even though they're older than what we would traditionally think a dependent's age is going to be. So this runs into the question of, well, who gets to claim the kids, especially if you have a decree that says it's joint custody. Joint custody is one of the worst things a family law attorney or two parties can agree on, because what it does is it creates ambiguity as to who gets to claim the children on the tax return. So you should always look for an agreement where the resident or where the child is going to be. You kind of work backwards. So if the intent of the parties is for the ex-wife to claim these children, we want to make sure that the children are going to be clearly living with the ex-wife longer than they're living with the ex-husband in any given year. A lot of times we run into situations with family law attorneys where they think that the divorce decree or the separation agreement trumps everything else, meaning it trumps the IRS test where it says in the decree ex-wife gets to claim the child. We don't even look at these IRS rules. That's what it is. And that's not necessarily true. The IRS rules and the rules in your divorce decree are both kind of the law of the land. And a lot of times they have to work concurrently, but they're going to be worded exactly in opposite of each other. And what usually happens then is you can file this form called an 8332, which is going to kind of sync up your IRS rules with your divorce decree. So for example, if you run into a divorce decree that says parent A gets to claim the child on odd years and parent B gets to claim the child on even years, the child might be living the same place that entire time. So if we go back to these rules for dependency, you're going to notice that when we get to this residency test for qualifying child, that, well, one of those years the parent was claiming the child as a dependent isn't meeting this test. So the way they kind of harmonize those two rules together is through this release. And this is telling the IRS that this child lives with me, but I'm going to release this exemption, this dependency exemption, to the non-custodial parent. It's going to allow me to fulfill my obligations under this divorce decree. And we're also not skirting any of the IRS rules as well. And that usually begs the question as to why you would ever want to release the dependency exemption. There's a couple of reasons why you'd want to do this. And this gets more into the back end of resolving these divorce issues and child support and maintenance if it's so awarded. If you're releasing the exemption to the non-custodial parent, it's going to benefit you in a couple different ways. Number one, most of these releases are contingent on timely child support payments. So a lot of times you can condition giving this dependency exemption to the other party by making sure that the child support is going to be paid on time, and because you're allowing that other person to claim these children as dependents, their net income is going to increase. And if their net income increases because their tax liability goes down, the child support is going to go up. Okay? So at the end of the day, now if you have these slides, I'm not going to really go into too much detail on this, but if you can print it out, kind of look at it and think about it, this is kind of a mock-up return, and it kind of shows you the impact of what would happen where we have a family of 5 and what's going to happen where this ex-wife is releasing these 4 exemptions to a higher earning divorcing party. Okay? And at the end of the day, everybody's going to really benefit from this because the person who's able to claim the children as dependents is going to have a lower tax liability. The person giving up the dependents is going to get more in child support, and if their income's low enough, it's not going to benefit them anyways because they're not going to have taxable income in the first place. So that's kind of a long primer in terms of some of the issues that we see here with victims of domestic violence. A lot of times the most common issue that I see is cases involving innocent spouse, where the parties were living together and whether there was violence or not, the parties split, and then the IRS sends them both a letter saying, you didn't put something on your tax return, now you owe us some money because any number of reasons. And there's a way to circumvent that. Let me get to those slides here. And that's through innocent spouse relief. An innocent spouse relief is essentially you telling the IRS that I know I signed a joint return with this person And when I signed it, I was in good faith thinking that the information on the return was correct, but now it appears that that's not correct, and because of my specific situation, I shouldn't be held personally liable even though I signed this return. Okay, so this is really the bulk of the information that's going to be helpful for you guys as advocates working with domestic violence survivors. And I'll kind of explain this through a hypothetical. So let's just say that you have a client and they're in an abusive relationship where, in addition to the physical abuse, the spouse is also very controlling in terms of the household finances. The abuser goes out to the casino and wins $50,000, and that income never shows up on the tax return. So instead of putting it in a bank account, he puts it in his own account, or he spends it on who knows what. But the other spouse is just completely in the dark in terms of this $50,000. So they file a tax return in 2011, and again, that income's left off. In 2012, the couple splits, and then a year after that, the IRS examines the return, and very easy for them to determine that this income was left off, because when you win over a certain amount at the casino, they're going to make you sign on the spot acknowledging that you've received that money, and that's going to get sent to the IRS directly. So because of that underreported income, the taxpayers are both jointly on the hook for $15,000, which reflects an increase of taxes, interest, and penalties. Okay? It's really an unfair outcome for this abused spouse. Is we have somebody who was facing physical abuse, finally was able to get up out of that arrangement, and now they're kind of being brought back, or taken back down through this potential IRS issue. So with innocent spouse relief, well, let's see. I guess just by using this chat feature, since we have a few people on here, do you guys see this in your practice here where your clients are mentioning these types of issues? I'll just give you a minute to, if you have any thoughts, to utilize the chat feature. And you can continue to type away while I pick up the rest of this. But with innocent spouse relief, it's going to allow you to sever that liability that's assessed on the return. And it's kind of the easiest way to look at it is this is more or less a two-part test. Is that number one, it's not my tax to begin with. So in other words, you can't just use the fact that you're no longer married kind of as a shield to say, I shouldn't have to pay this tax because I'm no longer married to this person, and that's the end of it. So if the person you were married to was very successful and had a business where you lived in a very nice house and you had 2 cars, a vacation home, a boat, and you just lived a really lavish lifestyle, and then you failed to report income on your tax return, you're not going to be able to persuade the IRS that you shouldn't be liable for this tax because you may not have direct access to it, to the income, but you benefited from the situation. The example that I gave you is very easy because it's a situation where somebody's earning a large sum of money all at once and the other spouse has no benefit of it. Okay? So you have to be able to argue that it's not my tax and there's some other compelling circumstance that would preclude you from having to pay taxes on it. And a lot of times this is going to be a successful case where there is some sort of physical or mental abuse, there's financial manipulation, or similar circumstances. And really, to the IRS's credit, in recent years they've kind of come around to these issues involving domestic violence where it's almost to the extent that anything in tax administration is a slam dunk for these innocent spouse cases. If you have documented domestic violence and are claiming innocent spouse relief, it's becoming very easy to get relief in these situations if you can prove that it's not your tax. whereas it used to be very difficult because you would have to really prove the violence. Even if it was documented, you'd have to make, build a case for it, where now the IRS is going to look at a police report or some other report, and they're almost going to kind of acknowledge that in these types of cases, we see a lot of trends where there's physical abuse and there's also financial manipulation. So as long as we can reasonably be assured that you didn't benefit from this income that was left off, we're going to grant you relief in this situation. Any questions so far on innocent spouse relief? Feel free to use the chat feature. I'll try to multitask and look at these questions as they come in. So there's a couple of different ways to handle these issues, and this I'm going to be a little bit more brief in this respect because I'm not sure that the advocates on the phone are really taking this step. This is more or less something that the clinicians in the tax clinics would be doing, but I think it's good kind of background information as you're screening some of these cases in the event that you're trying to make a referral to a tax clinic or another pro bono tax professional. So a few years ago, it was just so much harder than it is today to get these innocent spouse cases resolved. So the first question we would ask is whether or not this is a valid return. And what that means is that did the taxpayer actually sign the return? Because if the taxpayer never signed it, it's not considered a valid return. So it's a very fundamental rule of tax administration is that if you don't sign it and there's one out there, it's not valid. So you can correct that by filing your own return that you're going to actually sign. Now, of course, what made this much more difficult is the digital age where most returns are e-filed and we don't have signatures anymore. We have an electronic date stamp. And that's why this has become increasingly harder to prove. Whereas in the past, we could actually look at the signature and compare it against the taxpayer's actual signature and say, hey, this is completely, this is clearly a forgery. It's in the same pen, the same style as the other person. They write the numbers the same way. And we could go in and say that this is not a return that was signed by the taxpayer. So we don't even need to get into any of these other issues. This is a void return. There's other issues that we're coming up with that in terms of this tacit consent where the person might not have physically signed it, but there was some sort of consent. Either the person agreed to it or they had substantial knowledge of the information and it was a custom that the couple would file a joint return and there was no objections to it. So in those situations you would have tacit consent. And I have some more background information in this slide about special rules if there's duress. So if somebody's putting a return right in front of you and say, you better sign this return, or if you know it's good for you, those are other ways in which you can challenge the validity of the return. But really, I don't think it's as beneficial to do that in terms of advocacy. I think the easiest way to do it now, given the IRS's kind of coming around on these domestic violence cases, is to just request the innocent spouse relief. And there's three different grounds of innocent spouse relief. The most common that we see in domestic violence situations are under Code Section 6015F, which is just it's called equitable relief. And this is essentially going to be kind of a catch-all provision if they don't qualify for relief under Code Section 6015B or 6015C. Okay, essentially is saying that based on these equitable reasons, meaning this person was in a relationship where there's domestic violence, they had no access to the income that was understated, we have an equitable argument or reasoning why we should walk away from the liability. So there's a couple more background slides here that are kind of more for your benefit and I'll kind of gloss over those. So again, within
can I just ask, try to understand that you can, so one way you can do it is to say that yes, it has a signature, but it wasn't mine, and so I can file for innocent spouse, or I file that's a tax form. But if I signed, but under duress, then I can claim innocent spouse. Is that right? Am I understanding that correctly?
No. So there's two different ways before you even get into innocent spouse. And again, this is kind of like the old paradigm of we first want to try to challenge the validity of the tax return. So in situations where they were signed under duress, that would technically be a void return. So now, because it's been increasingly easier to file for innocent spouse relief, it's we've had a shift in how we approach these cases. Because in prior years, it was a lot easier. It was still difficult to do this duress or this void signature, but relative to where innocent spouse relief was at the time, it was easier to go to that route. Now, since they've really changed a lot of these provisions for innocent spouse relief, most of the cases I go to, I get funneled to me, I don't even really go through that duress or the void signature, because it's a lot easier. If I can substantiate the abuse, then I can get relief a lot easier through innocent spouse relief. And a lot has really gone down with this area of law in the last 5 years. There was a case that the IRS was fighting called this Lantz case, L-A-N-T-Z. And if you look that case up, it's pretty interesting because there was a statute of limitations in which you could dispute these issues or request innocent spouse relief. And what was happening was you were having these victims of domestic violence. They were leaving the household, and they were kind of off the grid because they weren't living with their spouse. They weren't filing a tax return. And the IRS really didn't know where these people were. But they were still trying to collect the tax. And there was a 2-year statute of limitations from when they first started trying to collect the tax as to when you could request innocent spouse relief. So what was happening is 2, 3, 4 years down the road, the victim of domestic violence would get back up on their feet. They'd start working again, and they'd be getting a $4,000 or $5,000 tax refund, only to find out it's been offset or taken to pay this tax debt that they had no idea existed. And then they were precluded from saying that, hey, I don't owe this because this is money that my ex won at the casino and I had no benefit to. This is really causing a tremendous hardship on a very sympathetic population of people, and that's what that Lantz case was about. And I think it was going to potentially get picked up by the Supreme Court, but the IRS eventually kind of threw up the white flag, and they kind of surrendered on it. And the IRS has changed their rules on the statute of limitations for requesting relief. And now it's essentially you can request relief to the extent, so long as that the tax liability is on the books. So if it's 4 years, 5 years, 6 years from now, you can still request that relief as long as they say that you still owe it. Okay, so that was a huge victory for victims of domestic violence. So innocent spouse relief, I'm not sure, again, if the advocates on the line here are requesting that themselves or if they're farming that work out or referring it to a tax attorney or a tax clinic or some other pro bono help. But that's going to be done on a Form 8857. The other thing to consider with requesting innocent spouse relief is that the non-requesting spouse is going to be put on notice that this request was made. So when you have instances of domestic violence, you may have a situation where the abused person has left that household and they don't want to be contacted. In fact, there's serious repercussions if they are contacted, where there's a threat to their safety. So that's always a consideration when requesting innocent spouse relief, is it kind of forces, wrapping this abuser back into the conversation. The IRS is very critical, or very, I'd say, very proactive in trying to make sure that there's no inadvertent contact or disclosures to that non-requesting person as to where this requesting person is now living. So regardless, you still want to put in just a Sharpie in the top right-hand corner of this form is to write victim of domestic violence. And that's going to put a special indicator on the account, and it's going to supposedly have added safeguards for just inadvertent disclosures and things of that nature. So that's something that they do on the back end, and I'm not really familiar with their computer program. So the only extent that I know is that it's supposedly an added layer of protection for this client population. So kind of in closing, in terms of innocent spouse relief, the best advice I can give to anybody, and this kind of cuts across all populations, is that if you're running into situations where you have potential identity theft, somebody else claiming you as filing a joint return or claiming your children, you can always want to e-file on the first day of the filing season, because that's going to avoid a lot of issues. Because if somebody else tries to claim your child or file you as a joint taxpayer, if you've already filed a return or have already claimed this person as a dependent, it's going to force that subsequent return to be rejected, and they're not going to be able to e-file. They could still paper file the return, but they're not going to be able to e-file, and that's going to kind of put you at a serious advantage if you're filing early in the season. Because if you're on the opposite end of that, where somebody else filed on the first day of the filing season, then you have to paper file, and you essentially have to prove to the IRS that you're able to file your own return or file claiming your children. And sometimes that's going to be problematic because you might not have the records. It's going to tie up the refund for several months, and you might be really desperate to get that refund. So that's why it's very important to e-file early on in the season. I have another couple slides here for injured spouse relief, and that doesn't really touch on this client population, but it's important to know that it exists, because this is a provision that allows somebody who's bringing a tax debt into a new marriage to protect that other person from the refund, from their refunds from being offset. So essentially it's a way where, and this is going to segue into Roxy's talk about earned income credit, is that if you owe child support arrearages, student loan defaults, or any other state or government overpayments, and you file a tax return and you get a refund, they're going to take that money automatically. If you file a joint return, even if it's the other spouse's tax or liability, they're still going to take the entire amount. Injured spouse relief is a way for the taxpayers to still file a joint return, but kind of portion out the amount that gets offset and retain some for that other spouse. Okay. So I think I've just about went over on my time allotment here. But I'll, if you have any questions, I'll be monitoring the chat feature here. Roxy's going to talk about some of these credits and benefits, and she might
Well, Andrew, I think sorry about that. I too quickly gave Roxy the floor, not realizing that then put you on mute, so my apologies.
Okay. So that's a good indication I should stop talking. So without further ado, then I'll defer over to Roxy, and thank you for your attention. If you have any questions, feel free to give me a call or email me. My email information is on the second PowerPoint slide.
Great. Thank you so much, Andrew. And I've seen you present before and was blown away when I saw you. It's been like 2 years ago now. But so much good information. It's a little mind-boggling. Like, it's so much. So, but this is it's so good for me anyway, just as a reminder of the things I need to at least pay attention to. And as advocates, I think sometimes we get overwhelmed because we're not catching on to all the nuances and all of the details, but it's okay. You don't have to know everything. We're not asking you to memorize these slides, but to know enough to know when to reach out, I think, is the biggest thing. So to know when you need help and when we should be reaching out on behalf of the survivors we work with.
Right, and especially just kind of in closing, again, all of the stuff I talked about with innocent spouse and who gets to claim the children, really the best service you can do to your client is to do a comprehensive kind of tax checkup with them, because you don't need to be an expert on innocent spouse, but what you do need to be asking is, did you file a tax return this year? If you did you file a return the year before? Did you file a return the year before that? Because there's a 3-year statute of limitations on refunds. So if they haven't filed for 5 years but have been working, they're probably going to be getting money back. And that money could get them out of the situation that they're in right now. Perhaps they're in an abusive relationship because there's that financial insecurity and they don't really have many options, or they're returning to a bad relationship because of the financial insecurity. So that one question of tell me about your return filings for the last couple of years really could get them out of the jam that they're in.
Yeah, great reminder. Great reminder. Well, thanks, Andrew. We're going to go ahead and then pass it on over to Roxy. We've had a little technical difficulties with Roxy's connection, so I believe she now has the floor. Roxy, can you hear us? Maybe not.
Hi, can you hear me?
I got you now. Perfect.
Okay, great. Good afternoon, everyone. So as Andrew mentioned, I will be sharing more details about some of the tax benefits that are available and ways to claim them, as well as some resources to assist you as advocates. First, I do want to mention, as was just noted towards the end, that this is a lot of information and you don't need to memorize it. As part of the Center's National Tax Credit Outreach Campaign, we definitely encourage people to know that you don't need to be a tax expert to engage in tax credit outreach activities. And so as I go through some details about the tax credits, please keep that in mind. Also, I'd like to ask you to keep in mind and think about the ways that these tax credits can benefit advocates as well as survivors. And so as you learn more about who's eligible and who qualifies to claim the credits, you can probably start thinking about some others that you will want to inform them about the credits. So I'd like to go ahead and move forward with the slides. On my screen, I'm still seeing Andrew's slides.
Oops, sorry about that. On mine, I have yours up. Can somebody else type into the chat which slide you're seeing, if you see the Roxy's one with purple and blue, or if you still see Andrew's? Somebody could just type in the chat section. Mine's on Andrew's too. Okay, well, let's see here.
Okay, let's see. Oh, that doesn't work. It won't let me do that. Okay, so
Roxy, select your tab, Roxy. Do you see your tab at the top?
I can't touch it. I just tried. It's not doing anything.
Okay. Let me see what else we can do here. Sorry about that, folks. Let me try this one. Okay. Roxy, are you there now?
I still don't see anything yet.
Okay.
Do any of the participants?
I have you signed in twice. For some reason, your name's showing up twice, so I don't know if
Let me see. Hold on. Okay. Oh. Okay.
There we are.
Okay, great. Hopefully that worked.
Okay. Okay, wonderful. Thank you. Okay, so first, just a brief overview. Two of the main tax benefits that are available are the Earned Income Tax Credit and the Child Tax Credit. And as Andrew mentioned, these are important benefits because they are refundable. These tax credits can help both low-income working families and individuals. They help to offset income and payroll taxes. They can supplement wages, and they can provide a work incentive, and that's actually built into the structure of the Earned Income Tax Credit. In addition to being refundable, some workers can actually claim both the Earned Income Credit and the Child Tax Credit, and the credits can help even if someone doesn't actually owe income tax. So as we saw earlier, there is an income threshold to have to file a tax return. And if you earn less than that, some people may decide, oh, well, there's no point in filing a tax return. And the benefit is that you may actually get a refund even if you are not required to file a tax return. So the reason why these tax credits are so important and so powerful is that workers really use these credits to help take care of themselves and their families. Research confirms that the credits are often used to help support some of those basic needs, such as child care, transportation, food, clothing, shelter, medical expenses, rent and utilities, as well as auto repairs. So let's take a closer look at the Earned Income Tax Credit first. So with the Earned Income Tax Credit, you can see that it is based on the number of children a worker is raising, their earned income, and also whether they're married or single. So this chart shows that the structure of the Earned Income Credit, you can see there's a level for workers with 3 or more children, 2 children, 1 child, and no children. And the numbers in the column on the right are the maximum amount that the credit is worth. So maximum meaning that all workers will not see that full level, that full refund, and the other factor, it will depend on where their income falls within these upper guidelines. It's important to note that while there is an income maximum, there's not an income minimum. So even if someone earned $1, they may be eligible for the Earned Income Tax Credit. If someone worked part-time or if they work sporadically throughout the year, they still may be eligible to claim the credits. In this chart, the middle column with the income guidelines is for single workers. So for workers who are married, you would add $5,430 for those upper income guidelines. And then the other factor is that for investment income, you cannot have investment income that exceeds $3,350 for tax year 2014. And investment income in this case is really the earnings on investments. It's not actually an amount that's held in savings. So it would be the earnings on stocks, bonds, or capital gains distributions, for example. And so if someone had that type of investment income, even if their annual income was less than the amounts in this middle column, they would not be eligible for the Earned Income Credit. And you can also see noted on this slide that workers not raising children do have to be between the ages of 25 and 64. We talked a little bit earlier, Andrew mentioned that for the Earned Income Credit, you must file married filing jointly to be eligible to receive the credit. And there is, so if you're married filing separately, if you're within these income guidelines, you wouldn't be eligible to receive the credit. There is an exception that can be helpful for some domestic violence survivors, especially when safety is a concern, and filing jointly would actually put their lives in danger. So a separated parent can claim the Earned Income Tax Credit without filing a joint return with the other parent if that parent has lived apart for the last 6 months of the year and the child lived with one of the parents for more than half the year, and that parent paid more than half the cost of maintaining the household for the year and is eligible to claim that child as a qualifying child, then under those circumstances, someone married filing separately would be eligible to claim the earned income credit. So this is the chart that you saw earlier. This is for tax year 2014, and so you can see the structure of the earned income tax credit is that the more you work and the more you earn, the larger your refund amount is, and then it reaches a point where it plateaus and then it slowly declines. So this is different from some other benefits that are available in that it doesn't just cut you off if you earn $1 more than you did in the previous year. And here you can see each of the different colors in the chart represents a different level of children that one has, and then there are dotted lines that represent the amounts for married filing jointly. So the child tax credit is structured a little differently. The child tax credit is designed first to reduce or eliminate any income tax owed or withheld, and so it functions as a non-refundable credit initially. Then, after any income tax is eliminated, workers may also get a refund, and this is referred to as the additional child tax credit. And so for the purposes of this presentation, whenever you see child tax credit or CTC, it's referring to that refundable portion. So the child tax credit is worth up to $1,000 for each qualifying child. The refundable portion kicks in for workers who earn more than $3,000. So earnings above $3,000 in 2014 are eligible for a child tax credit refund. Here you can see that the income guidelines, those maximums, are a lot higher for the child tax credit than for the earned income tax credit. You'll also note that you can get the child tax credit if you are filing as married filing separately. So one other thing to note about this slide is that these income guidelines are the maximums to receive the child tax credit that's up to $1,000. So when someone earns more than these amounts, they may still be eligible for a child tax credit. It will just be a reduced amount. There is not a maximum number of children that can be claimed for the child tax credit as well. So how do the credits actually work? Well, one of the first things to note, as is indicated by the name, the Earned Income Tax Credit, is that you must have earned income. And this generally will come from earnings from a job, wages, salary, tips. There's also self-employment income that can count as earned income as well. And you can see some of the other things that count as earned income. What does not count, what is important to note, is public benefits. So if someone only has income from public benefits, then they would not be eligible. If they receive public benefits and they work and they have earnings from another source, then they would be eligible to claim the tax credits. And then other forms of income, unemployment, child support, interest on bank accounts, investment income, all of that does not count as earned income. So here's a little example of how this actually works for a family. So this is Maxine. Maxine is a single mother. She's raising a 6-year-old son, and she earns $19,000 in 2014. She has $200 in income tax withheld, and her total tax refund is $4,114. So this includes a $1,000 child tax credit as well as a $3,114 earned income tax credit. And so you can just think about some of the ways that Maxine would be able to use that refund to help care for herself and her son, some of those ways that we saw earlier. Now, one of the most important things that Maxine has to do to actually benefit from this refund is that she must file a tax return. And this is how you claim these benefits. And so this is something that's different from other public benefits that are available, in that there's not an actual interview process per se, and you don't have to go to a certain office or fill out an application. You must file a tax return. There are specific forms that one would file to receive the earned income credit and the child tax credit, and you can see those on this slide. Another thing to note is that workers who maybe are just learning about the earned income credit and the child tax credit for the first time, and they think, oh my goodness, I haven't been filing a tax return. I didn't have to, so I really didn't see the point, or I just didn't feel like being bothered. I was concerned the IRS was going to come after me, and wow, I really wish I would have been doing this years and years ago. People can claim the earned income credit and the child tax credit for up to 3 previous years. And so this can be a huge benefit. This would be for each year the earned income tax credit is adjusted for inflation. So they would have to meet the eligibility rules and requirements, the income guidelines for each year. So this is another very beneficial aspect of these tax credits and an important outreach message. So the earned income tax credit and the child tax credit are structured a little differently. We'll go over a few of those differences now. So for the earned income credit and the child tax credit, again, these are benefits for people who work, so it doesn't matter if it's full-time, part-time, or self-employment. You can also receive public benefits. You can be married or single, raising a qualifying child, which we'll take a look at next. And then we saw that there's an earned income tax credit that's available for some lower income workers without a qualifying child, and immigrants who are legally authorized to work. So the child tax credit is also available to immigrant workers with an individual taxpayer identification number, or an ITIN. And ITINs are issued to people who are unable to get a Social Security number. There's also some non-custodial parents that can claim the child tax credit. So a qualified, yes?
We did have a question here I just want to ask in this section. The question is the total tax refund here including EITC, or is that separate?
Are you referring to the example of Maxine?
I believe so, yes.
That's the child tax credit and the earned income tax credit. It's both. So in that example, the earned income tax credit refund was $3,114. The child tax credit was $1,000, and so the total combined refund was $4,114.
Gotcha. And on one other question about income, what qualifies? Does pension qualify as income in that for that?
No.
No. Okay. Thanks. Thanks so much.
Okay. So the qualifying child is not just a son or a daughter. So there's a lot of different types of relationships that can qualify for a qualifying child. So this broadens the pool of eligible families who can benefit from these tax credits. Adopted child, stepchild, grandchild, brother, sister, stepbrother, stepsister, as well as some foster children are eligible, can be eligible as a qualifying child for the credits. There's also a residency rule for a qualifying child. So a child must live with the worker in the U.S. for more than half the year. That does not have to be consecutive. It does have to, at the end of the year, add up to more than half the year. And what's important to note with that is that when someone submits a tax return, they are not going to be asked to submit documentation. However, if there was a discrepancy and someone else is filing a return and trying to claim the same child, then the IRS would ask for proof. So someone would want to be able to demonstrate that the child lived with them for more than half the year. And the differences between the Earned Income Tax Credit and the Child Tax Credit for a qualifying child is that for the EITC, a child must be under age 19, or they can be under 24 if they're a full-time student, and they can be any age if they're considered permanently and totally disabled. For the child tax credit, they must be under age 17. And these ages are as of December 31st of the year. So December 31st, 2014, you would want the qualifying child to be under these ages. If they're over it, then even if someone meets all of the other guidelines for these tax benefits, they wouldn't be able to claim them. So in filing tax returns, many people seek help from commercial preparers. And looking at the Earned Income Tax Credit alone, more than 60% of people will use a commercial tax preparer. And there are fees that are associated with just filing the return that can range from $85 to $120. And some commercial preparers will tack on additional fees. They may have a fee for the forms that you need to file. For example, for the Earned Income Tax Credit, if you have children, you have to submit the Schedule EIC. So there may be an additional fee for that. Some tax preparers may charge fees based on the number of children that you have. And so the cost of tax preparation can really add up. There are also commercial tax preparers that will issue refund anticipation loans or refund anticipation checks. And refund anticipation loans, also known as RALs, are essentially very high interest loans. And the way it works is that a commercial tax preparer forms a relationship with a financial institution, and they will, for the RALs, the commercial tax preparer will process the return, and then they will issue a refund based on what they feel that it is, based on their work doing the return. They have a relationship with the financial institution so that they can provide that refund. The problem is that when the IRS actually gets to process the return later than when the refund was actually provided, if they see that the refund amount is less than what the commercial tax preparer has already provided, then it is the taxpayer that is stuck paying the difference. And that is on top of the interest of the loan, which can be over 180%. I've heard of over 300% in some cases. So RALs are very dangerous because there's no guarantee that the refund will equal the loan amount. And there has been a decline in RALs because one of the tools that was available to help commercial tax preparers assess the risk is no longer something that they can use. It's called the debt indicator. So since that is no longer available, there has been a decline in RALs, and there has been an increase in RACs. So with the RACs, the commercial tax preparer has the relationship with the financial institution. They create like a temporary bank account, and so they file the return, wait till the IRS processes it and has it deposited in this temporary bank account, and then they deduct fees before they provide the refund to the client. And in some cases, they don't even provide the refund to the client. They just keep it all for themselves. So if a client actually has their own bank account, then this process is no faster than having a refund directly deposited into their own account. So there are alternatives to the commercial tax preparation, and there is what's known as the VITA program, Volunteer Income Tax Assistance, which is an IRS-sponsored program that is available in communities across the country. Volunteers go through training, and they also must become certified to become a volunteer income tax preparer. There are other free tax preparation programs available as well in some communities. One of the larger ones is the AARP Tax Aid Program, which is often operated in conjunction with tax counseling for the elderly. And these sites also provide same services with the free tax preparation. With those sites, they are designed to help serve people over 60, and they will not refuse anyone if a younger taxpayer comes in needing assistance and meets their income guidelines. So there's phone numbers and websites for you to find the free tax preparation sites in your community. There are also some online services as well. MyFreeTaxes.com is another option that's available to file a federal tax return as well as state tax returns for free. So a few other tax benefits that are important to know about. There are some states that have state earned income tax credits, and state EITCs are a percentage of the federal earned income tax credit. So on this slide, if you see your state, the number in the parentheses represents how much that state EITC is worth. For the ones in blue, those are refundable credits, so the same way that we talked about the EITC being refundable. For those that are green, it's non-refundable, so it will reduce any tax liability that one has. And in the case that they do have one, then it could result, by reducing that tax liability, it could result in a larger refund. The Child Independent Care Credit is another non-refundable tax credit, and so this is a credit for people who pay for child care expenses in order to work. It can also be claimed if one pays for care for a dependent with disabilities. And so the credit is worth a certain percentage of expenses, and there are some states that have their own state level credit as well. Let's see here. Okay, Kim, can you advance the slide, please? So next is the new health insurance premium tax credit, which Andrew spoke a little bit about earlier. So this is a federal tax credit that can help pay the cost of health insurance premiums. And this is for starting for coverage in 2014. So this is completely new. People had the opportunity to elect to get the credit in advance, and so there was a portion that is paid monthly by the IRS to the private insurance plan that one has chosen, and this would be through the federal marketplace, or some states have elected to run their own marketplaces. And so the insurance must be purchased through the marketplace to be eligible for the premium tax credit. So if someone has elected for the advanced premium tax credits when they file their tax return next year in 2015, that advanced credit will be reconciled with their income. They had to project what their income would be in 2014. And then depending on if there were any changes or not, they may get a refund, or they may actually end up owing if they had some unreported changes to their projected income. Now, if someone doesn't have health insurance, most people will have to pay a penalty to the IRS if they don't have health insurance. As part of the Affordable Care Act, there is an individual mandate for everyone to have health insurance. Now, there are a few exemptions to that, and some of these include being low income, domestic violence, insurance choices are unaffordable, hardship, ineligible immigrants, and Native Americans, and there's several other exemptions. The one that I want to talk a little bit more about right now is for domestic violence. So Andrew mentioned this earlier, that there is an exemption for domestic violence, and this applies for the month before and the month after, and it could very well be for the entire year. And so for a hardship exemption, one must apply for that exemption through the marketplace, and there's a link to that application here. And it's a general application for several different types of exemptions. So for some exemptions, they do require some type of supporting documentation. There is not a requirement for documentation for the domestic violence exemption. And as was mentioned earlier a little bit as well, I believe, with the premium tax credits are available even if someone files their tax return married filing separately. There is a provision so that if someone is in a situation where they have to file married filing separately, they can still be eligible for the premium tax credits. Next slide, please. So
I'm sorry, Roxy. I'm on the slide here says new health insurance premium. Is that the right place I'm supposed to be?
The next slide. Who qualifies for the new credit?
Perfect. On it. Thank you.
Okay. Thank you. So this credit is available to a wide range of people. So families and individuals with income between 100 to 400% of the poverty line are eligible. We just started the new enrollment period on November 15th for health insurance coverage for 2015. So if you know someone who didn't get health insurance before, has recently become uninsured, they are now eligible to apply for health insurance through the marketplace. And in terms of the premiums and how much value does the credit provide, consumers would pay between 2% and 9.5% of their family income. It's based on a sliding scale. Okay, next slide, please. So this just gives you a better sense of who is eligible, looking at 100 to 400% of the federal poverty line for 2014. Here you can see what that actually looks like for households that range from 1 to 5. Next slide, please. So this is an example. Jessica is a single parent earning $30,000 working for a small business that does not provide health insurance. She's raising 2 children over the age of 18. Jessica enrolls in her state marketplace and chooses a mid-range benchmark insurance plan. The total annual premium is $6,850. Wow, that's a lot of money. She says, I cannot pay that. So how does Jessica get coverage? On the next slide, we see that because of her income, she is expected to pay no more than 4.2% of her income, which is $1,250 or about $104 per month. So her annual tax credit would be $5,600, and she could elect to have that paid to the IRS, paid by the IRS to the insurance company monthly. Next slide, please. So there are some states that have elected to expand Medicaid as well, and so some people may have the opportunity to gain health insurance through the Medicaid expansion. And enrollment in Medicaid as well as in the Children's Health Insurance Program is available year-round. It's not just during the open enrollment period. Next slide. Helping families get their premium credit. So a couple of opportunities for advocates are, one, referring clients to the marketplace in your state and to navigators or assisters to help clients enroll in health insurance during the open enrollment period, which goes through February 15, 2015. And as you work with clients now, you can ask them if they're enrolled in health insurance. If they're not, you can refer them to the marketplace. And if they are, you can do a checkup and ask them if they've had any changes to their 2014 income. If they have, or if they've had any family changes, birth of a child, for example, then they would want to report that so that they do not end up owing when they actually file their tax return. And so you can get more details about all of that at the Federal Marketplace website, healthcare.gov. So as we close, I want to share a few tax credit resources with you. First, again, I want to go back to the idea that you don't have to be a tax expert to engage in this work. So there are tax credit outreach coalitions that are dedicated to doing work to inform people about refundable tax credits and providing free tax preparation as well. So you can connect with the local coalition in your area. This slide shows the website link to where you can see the coalitions in your area. If you don't see your area listed, then you can certainly contact me and I can help you get the information that you need. On the next slide, there's a little bit of information again about what low-income taxpayer clinics can do and the support that they can provide. Andrew shared earlier that you can find the one that's in your state, and here is a link to the listing of all of the LITCs. And finally, there is the Center's Tax Credit Outreach Campaign. So we do have tax credit outreach kits that we produce annually. They include detailed information about the tax credits and outreach materials, as well as strategies for promoting the tax credits. We have a special section on helping survivors of domestic violence claim the credits as well. And there are resources on our website, eitcoutreach.org. I've included a direct link to our page for domestic violence survivors. And on the website, you'll find other resources as well, including flyers in 21 languages. There's an EIC estimator to help someone get an understanding of how much of a earned income tax credit refund they may potentially be eligible for, as well as many other outreach resources.
Is that it?
Yes.
Are you wonderful? Well, thank you so much, Roxy, and to Andrew. All the information is so helpful, and I'm sure others are feeling a little overwhelmed, but at the same time, better for the information for sure. So thanks so much. We're a little over on time, but if there's any questions, you can type that in the chat, or you can email myself and or Roxy or Andrew, and we'll get those questions answered. I don't see any questions coming up in the chat section, but some thank yous, so that's great. So those of you who joined us, thanks so much for your time, and we will be sending out a link to both the recording as well as both Roxy and Andrew's PowerPoints, so you'll have those. And don't forget, December 11th, we will be having another webinar called Tax Time, Making the Most of It, with Roxy as our primary presenter on that one as well. So a good time to bring others forward. Questions coming through asking when will the PowerPoint be made available. I will have the link and the PowerPoints available within 24 hours and send it out to everybody that registered. So definitely those of you who are on this call, as well as if you registered but couldn't make it on, will also be getting it. And I probably will go ahead and just send it out to the Moving Ahead listserv as well. So with that, I'm going to go ahead